Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. And using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated cryptocurrency, business, real estate, save a failed 1031 exchange, eliminate some of that estate tax, and diversify your wealth into investments like passive real estate, all tax deferred. Pretty cool. My name is Brett Swartz. I'm founder of Capital Gains Tax Solutions. And each and every episode, we're joined by some of the best real estate, financial, and wealth minds in the world, where they share their ideas and deal stories. So together we make tax deferral strategies simple and passive income plans achievable. We're also streaming expert CRE secrets as well. So all the commercial real estate experts out there, we're looking for a leg up and learn from some of the best in the business. We are here to also provide some amazing content around that. I'm excited about our next guest. He's out of the state of Minnesota. He went from a software tech startup veteran and now he's a CEO of Black Swan Real Estate. And he's always kind of been an entrepreneur at heart. Before real estate, he enjoyed an extremely successful career in enterprise software. In over 9 years, his first startup went from 13 million in venture capital to 100 million in private equity sale. After that, he helped the Mayo Clinic create a software development startup, which resulted in him leading 13 teams of engineers after only 3 years, and so much more. And we're going to be talking about how all of that helps him to leverage and help people create and preserve more wealth in real estate. Please welcome to the show, Nick Stageberg. Nick, how you doing?
I'm doing fantastic. It's a pleasure to be here.
No, absolutely. And for our listeners get to know you for the first time, would you give us a little bit more about your story and your current focus?
Absolutely. So I appreciate that introduction there. You got a lot of the highlights. We've got today a real estate private equity fund with about $1/3 billion in assets under management. So that's kind of my third startup, if you want to think of it that way. My wife is my full partner in the business, Elaine. She's a physician who trained at the Mayo Clinic, and we've got 4 kiddos, 8 years and under right now. So we like to have lots of irons in the fire across the board. So that's just a little bit more about us today and what we're excited about.
Excellent. And, Nick, I do believe we've all been given certain gifts in this life, and these gifts have been given us to be a blessing and help to others. What would you say is your number one gift or 2 gifts or strengths that you've been given, and how does it help how you help and bless people today?
Absolutely. So, in the most tangible sense of the word, we really do love to give back. 5% of all of our profit from our private equity fund and other ventures goes to charity. Last year, we had the great privilege to do an adaptive reuse, helped convert a 40,000 square foot abandoned office building into a school. And there's 240 kiddos that go to that school now. It turned out to be a pretty good real estate deal. We were $5.1 million all in on it. And it just appraised for $8.8 million. So there's $3.5 million that school now has that they didn't have before. To anyone listening to this podcast, if you have gifts to give, if you have talents, it's a lot more fun to use those talents to help other organizations grow like that than to just write a check. And I don't have $3.5 million I can give to a charity right this second, but it is pretty powerful to be able to help a charity come to have $3.5 million that they didn't have before.
That's amazing. Yeah. So I'd say creative ways of giving, which is awesome. So with that being in mind, Nick, what would you, and we're talking about investor focused passive investment. You can learn more about Nick by going to blackswanteam.com, blackswanteam.com. So Nick, let's dive right into the show. What would you say is the number one secret to being an investor focused passive investment or sponsor to help them invest?
Absolutely. So, I think there's a lot of groups out there that they're really focused on kind of a quick win and how can they kind of synthetically maximize IRR. And on the surface, it may seem amazing if you can buy an asset and sell it a couple years later for what seems like a big IRR on paper. But at the end of the day, that's not necessarily the best outcome for the limited partner, for the passive investor. So that limited partner, they probably would prefer to stay in that deal for a longer period of time. And if that deal's going so great, like why wouldn't you want to stay in that deal? Sometimes turning those assets really quickly, it benefits the general partner because they generate more fee income on acquisition fees and disposition fees, and ultimately does not give the best overall return to that passive partner, and particularly from a risk-adjusted and tax-adjusted perspective. So you typically do cost segregation, accelerated depreciation, bonus depreciation when you buy one of these apartment buildings, single-family homes, or if you're investing in any kind of real estate asset class there, you get this huge windfall of depreciation that you share with your investors. That I'm sure most listeners to this podcast are kind of familiar with how that works already. But something I feel like a lot of people don't stop to think about is if you go to sell that asset shortly after you purchase it, just a few years later, you immediately have to recapture all that depreciation and then pay capital gains on those returns. And of course, you could theoretically go redeploy that capital into a different investment to try to get more depreciation to make up for the depreciation you just had to recapture and the capital gains you had to pay. But it's a kind of a hamster wheel that you fall behind on each time. It's a good problem to have, but it's still a difficult problem to have. So our solution is very different. We target an indefinite hold period. We've actually never sold an asset. We return capital to our investors with a cash out refinance event, and then they stay in the deal forever. So this allows them to avoid the huge tax complications that come from constantly buying and selling assets. And our investors, I'll call more sophisticated investors that have been through that hamster wheel many times. They get a sense of relief when they invest in one of our vehicles. They're like, okay, so you're telling me that I can, put my money here and I can, hopefully catch up on the, depreciation, recapture, and capital gains from the last couple deals I got out of, and I don't have to worry about this, this capital event that's coming, hopefully not for many years down the road. And we find it really serves our investors and puts their needs
Got it.
first.
Got it. Okay, cool. So it sounds like it's a buy and hold forever situation. So never sell, only ever cash out refi. Therefore, you're not actually recognizing the gain. It's cash out refi money. Number two, others tend to maybe do more of a 2-year hold or 3-year hold or something like that. And they're doing the cost seg, which is, yeah, in a sense, it's kind of sexy up front, right? Because you have all this savings, but then you're getting hit with even more recapture. Is that a fair summary so far, Nick?
That's exactly right.
Okay, excellent. What's the number 2 secret to an investor-focused passive investment?
So we have a radically different business model, not just in how we buy these assets and target an indefinite hold period, but also the way we structure our private equity fund. So there's no asset level fees whatsoever. So there's no acquisition fee, capital event fee, disposition fee, loan recourse fee, marketing promote fee, and we don't get any of the profit from the venture until our investors have gotten a full return of capital. And then it's a 50-50 split after that. And if you kind of pencil all that into a calculator, you'll see that in almost any scenario, a typical limited partner, a typical passive investor, they'll come out ahead with the way we structure things versus a traditional real estate syndication structure or private equity fund structure where the limited partner might appear to be getting a larger share of the equity, but when you figure out just how heavy that fee load is, it can be very substantial in most cases. There's almost no scenario where a limited partner is going to come out ahead with that traditional structure, and then it keeps incentives just laser aligned because we only make money when our passive partners make money and only after they make money. So in any situation you encounter, we're constantly asking ourselves, okay, how can we just get the best return? And there's never this disalignment of incentives. There's lots of things to think about it. You have kind of a sophisticated audience here. So, think about a typical fee load on a project that's going extremely well. That general partner has this huge incentive to sell that project really quickly to kind of boost their fees that they can collect. They get a small portion of the equity return and a huge portion of their income from the fees. So if the deal's going amazing, they have this strange incentive to kind of churn that deal as quickly as they can and say, oh, we got this amazing IRR or what have you. When the thing for the LP in that situation would probably be to hang on to that asset, but the LP, they get compensated on an equity basis. So there's a huge disalignment there. And then let's think about if the deal doesn't go so well, which, in the years 2023, 2024, that's a not so hypothetical situation to contemplate. Well, let's say there's a preferred rate of return that's supposedly something that looks out for the limited partner's interests. But again, it just creates this disalignment of incentives. What if that deal, isn't hitting that preferred return? It accrues year after year. Let's say a few years go by and all of a sudden the GPs owe like a 20-25% preferred rate of return to their limited partners. Well, again, there's this huge disalignment of incentives now because the GPs, they get basically no compensation whatsoever for the deal returning, having a return on investment. In fact, the only thing they get income from is the fees. And indeed, they can often make fee income from selling the asset, even if the asset is sold at a loss. So there's this huge disalignment of incentives that can happen on both sides of that spectrum with a traditional syndication structure. There's good reasons why those structures are the way they are, and they theoretically do incentivize, good outcomes. But those incentives can become terribly disaligned in many very common situations, especially with the state of the market today. So we have an incredibly simple structure. We jokingly call it a lemonade stand model. Very easy to understand, no fees. We don't get any profit until our investors have gotten all their money back, and we find it keeps all of our incentives laser aligned and really puts the needs of our passive investors first.
Got it. Okay. Yeah. So it sounds like no fees of really any kind, and it's just a 50-50 split. So if like you're buying a $10 million asset, and let's just say you just keep it simple, 5 million, put 50% debt in it onto the deal. Investors come with the full 5 million. You guys manage, buy, operate all of the things and no fees whatsoever. And then, the property increases to, let's say, 15 million over 5 years, right? So it's about a 33% increase. And that scenario, you probably do a cash out refi at that point, but let's just say you did a cash out refi at that point of 10 million in this scenario. Let's say that's the number. And that they get their original $5 million back, and then they would split that other 5 million of equity that's there. So 2.5 million would go to you guys, Black Swan team. And then the other 2.5 million go to the investors. Is that a fair summary, Nick?
You nailed it. That's the nice thing about that structure. It's so simple that's easy to do some back of the envelope math, just like that. That is truly no more complex than that. Sometimes I'll have to go through like a 15-minute phone call with an investor. It almost seems too good to be true or too simple to be true. And they're like, okay, so what about if this happens? What about if this happens? No, it's truly just as simple as you just laid out there, Brett.
Okay, cool. Yeah, that makes some sense there. And then you mentioned on the other side, yeah, it could be like 80-20 or 70-30 with a pref return. And I think I heard that right as well. It's like, well, if the pref is building up, let's say it's an 8% pref or 6% pref, and in a couple of years the deal's not going so well, the sponsors essentially in debt to the pref, which then they look at it and go, well, I'm not making any money, but I'm doing all the work. And what you're saying, that in that scenario, the deal kind of crumbles. Is that what you were saying there, Nick?
That's exactly right. Limited partners often think of the pref as this like protection mechanism that kind of puts their interests ahead of the general partners. But if you really think about that for a second, like what if that scenario truly comes to pass where that pref is owed? You've taken away all incentive for that general partner to work hard to deliver return on the deal. So I see a preferred rate of return as often being kind of a marketing thing that gives limited partners a false sense of security and ultimately just disaligns incentives if it truly comes into play.
Got it. We're talking with Nick Stageberg, which I'm going to spell it for you because it's kind of hard to pronounce a little bit. It's at least for me, it is Stageberg. And you can learn and more about Nick and see everything by going to blackswanteam.com. Okay, so we talked about the first two secrets to investor-focused passive investment. Nick, what's the next secret to building an investment-focused passive investment?
So I think the secret to living is giving. As I mentioned, 5% of all of our profit goes to charity. We did, kind of one of the coolest things I feel like I've done in my life, helping, build a school last year. And then 5% of our profits goes to our team in the form of profit share. So we're very vertically integrated, and we make sure that our team understands that they own those apartment buildings that they're walking through. We have in-house lawn, snow, housekeeping, facilities, and of course, property management. So we have about 50 full-time employees here in Rochester and 30 in Tacoma, Washington. So we're very staff heavy. And we think that, being generous with all these people and making sure that they understand that they have a stake in this thing is one of the secrets to our success. We tend to, have extraordinary outcomes from an asset management and property management perspective. I think as a result of that, of being so generous with everyone that we do business with. And at the end of the day, that's what's going to get incredible outcomes for our passive investors. So we love to, kind of give of ourselves. We love to do, teaching and speaking. We typically do something, about once per day between Elaine and I, doing podcasts and other speaking engagements like this, being generous with our team members, generous with charity, and ultimately, I think, generous with our investors. I think that is a really motivating way to get out of bed in the morning. Once you have enough money, more money is not very motivating. It can almost become depressing. I remember when, my wife and I kind of hit financial freedom, it was actually kind of a tough time in our life figuring out what to do next. And at the end of the day, I think most people that arrive to the other side of that question, they come to the conclusion that the secret to living is giving.
Amazing. Secret living is giving. And let's dive into that profit share for a little bit. So in the profit share, income minus expenses is profit, right? And then you have $1 million of profit, or let's just say hypothetically, then you would say, okay, we'd give 50,000 of that to across the you said 50 full-time employees in some kind of
That's right.
way of, is it
Everyone
even
gets $1,000 approximately. Well, no, it's not even. There is a formula based on years of service, position in the company. But from a holistic perspective, you can think, yep, if we have a 50K profit share, we got 50 employees. We're actually having our all hands meeting at the end of this week where we'll share our profit share. And that's my favorite day of the year.
That's amazing. I think that sounds fun. And I'm curious, how do you, this is maybe because you built some amazing companies and you've scaled. So, I feel like hiring is a delicate art, rev share versus profit share, right? Stock versus, or equity or no stock, or, how do you, with the changing of of environments in real estate and in different deals and different markets, like how do you obviously lead with generosity and giving, but how do you come to those numbers? Like these are like a framework that you follow, Nick, that or like, how did you figure out it was 5% for profit share and the formula is, laid out for different employees in different years and such?
Great question. So the short answer to that question is iteration. I've had the great privilege to lead multiple very successful startups, first in the technology world and now in the real estate world, kind of taking a lot of models. I mean, when you think of like stock options and stuff like that, you probably think tech, and that was the industry that I was in for a good 15 years. That's not something that's as ubiquitous of a concept in real estate. It's kind of interesting. In fact, I would dare say there's really not a great culture, a standard kind of environment in the property management world. Sometimes general partners or investors will say that the property managers are just a step above the tenants and they're all liars and thieves and stuff like that. And they'll begrudge how you have to manage your manager and just have a lot of like really negative talk about their residents and their property management staff, which is just always pretty shocking to me to hear. I think that people behave the way they're expected to behave. People tend to rise to your expectations. So what we do is we have I would say a pretty fair compensation package for every member of our team, and we have extraordinarily high standards for those individuals, and they know that if they perform at a high standard, they're going to get the opportunity to participate in the incredible wealth that we're creating here, and that lets us attract really good people and motivate them. You could theoretically award equity, and I do see that sometimes used in the real estate world, but that gets complex, and I would challenge everyone to think really carefully before ever giving away equity, because now this person often has voting rights. Let's say you want to sell an asset or make some significant decision. Does that person now have a say? Even a minority say. It's another signature that you need to collect. An alternative to that is to have an entity that contains within it the equity shares for people that are in that equity share program, and then you have control of that equity. But even me saying that out loud gives you some indication that can get really complicated, right? Very quickly. Revenue share, I would say, can be an inherently unsustainable type of share to offer, because you have up years and down years in terms of profitability that may or may not be directly correlated to revenue. I hang my license at Keller Williams, and once upon a time they had a revenue share program in this organization, and they had to switch to profit share because they figured out, well, shoot, some years we do have really strong revenue but really poor profits, and then we're paying out this revenue share payment that frankly we're ill equipped to afford. So I really strongly recommend, I think profit share is the best way to do it, because that means that you have the cash to award to your staff, and it keeps your staff laser focused on the bottom line of how can we deliver performance this year in terms of the profitability of the company. And then that still really, really laser aligns your incentives for the future. So we'll tell our staff, we have a number. If we were to sell the company today, there would be a huge profit event that would occur in the company, right? So there'd be, let's say $10 million of profit realized. So there'd be, $500,000 of profit share paid out to the staff at that time of sale. And here's, the amount that you would get based on the formula today. That's something that we can know with scientific accuracy. And I think that gives us the best of both worlds, that we can tell someone, hey, you don't have equity in the company because there's a whole bunch of complexity and strings attached that go along with awarding equity. But you have something that's very close. You have essentially a profits only interest in the company, and if the whole company were to sell, here's what your payout would be today, and here's the profitability of the company this year, and here's your portion of that profitability for this year. So it's an incredible. It's like 0.01% of the complexity and overhead of an equity sharing program, and it still gets you the majority of the rewards. Something else to think about is if you ever do sell your business, it's very likely that you're going to have an earnout provision, and it's very likely that you would want to pay stay bonuses to your staff, right? So we already have the entire exit for our whole company built right into our profit share program that we're able to be really transparent about with our staff along the way. So let's say that there was a 1 year or 2 year or 3 year earnout or something like that. We'll make sure that those final profit share payments are in lockstep with that. So again, everyone's incentives are laser aligned from company inception to the full exit of that company.
Yeah, it sounds like obviously you've been very thoughtful and been through have a lot, right? So you got it all laid out and planned out, and I like the way that you put that. If we were to exit, and I'm curious about that revenue model, right? I too started at Keller Williams and now with EXP Commercial, and EXP tends to be it's like the fastest growing in the history of real estate, 90,000 agents, and a lot of former KW people there, and we kind of have that debate, like profit share, rev share, is it sustainable? Will it work? And how does it work? And the whole thing, but just to like try to get your hands around it and then be able to decipher it. And like I have our company Capital Gains Taxes, we're doing the deferred sales trust, and I'm looking at team members, I'm looking at rev share versus profit share, and then different ideas. And I feel like it's a bit of it feels like a bit of a mystery, right? I think the point is you start to do the thing and then you start to iterate and just try to lean on the way of being more generous. Is that a good way to think about it, Nick? And it sounds like you guys have solved it for the profit share. Is that a good summary, Nick?
That's exactly right. Keep things really simple and easy to understand in a way that's sustainable, and you will thank yourself later. And I say that as a person who tried to do this thing the wrong way in many past iterations. And I think that we've got a system that works really well for us.
Right on. I appreciate that, Nick. By the way, you can learn more about Nick by going to blackswanteam.com, blackswanteam.com. So we talked about investor focus, which is, first of all, never selling. Now, you mentioned something about if you sell the company, and I imagine when you mean the company, they mean they're buying all the real estate. So then what happens if that company's strategy is not aligned with you guys and they start selling? Or would that be worked into the deal? What is your thoughts on just that? Like 10 years from now, you're like, hey, we're never going to sell, but then the company comes in and sells everything. Any thoughts on if you were to sell the company and if they were to try to sell all the property?
Yeah, I mean that's getting into the weeds a little bit, but man, I love doing that. So that's something that we've put quite a bit of thought into. We're trying to build a thing that if we did sell, we'd sell the whole package. We've got an amazing team, amazing assets that we have developed with a tremendous amount of foresight, and the whole is much more valuable than the sum of its parts. So whatever it is that some future exit event would potentially look like, I sure hope that we would sell the whole thing as a whole. I really love what I do, so it's hard for me to envision a date when we would sell, but you always want to start with the end in mind, and you want to make sure that you do have multiple exit opportunities, because at some point we are all going to exit this earth, and there's no luggage racks on coffins. So I could see us rolling up into a REIT, into some sort of UPREIT maneuver or something like that. I could see the entire fund being purchased in whole. I think the most likely outcome is probably one in which the fund transacts to a new vehicle, in whole, that offers a liquidity event to all of our existing investors if they wanted to say, yep, I'm going to take my chips off the table and ride off into the sunset with these incredible gains, but also leave them the option to stay in the deal. And I really love these assets, and now Blackstone is managing it instead of Black Swan, but I still really believe in the assets, and the management team will still be in place probably for several years of transition. And this is modeled after what you typically see in the tech world. So everything I just described, I would say, is an SOP in the tech world. It's a little less common in the real estate world, where it would be, I would say, pretty common to kind of parcel out to part out a portfolio. But I think that we've created something really truly special with our staff, with our systems and processes, with the unique portfolio that we've created. So we own kind of more downtown real estate in Rochester, Minnesota, in around the Mayo Clinic campus, where Mayo just announced a $5 billion expansion to their campus. So just as an example, we paid about $10 million for half of a city block where we own, multiple adjacent parcels. And there's going to be a $1 billion building on one side of that parcel and a $1 billion building on the other side of the parcel. Like, it would seem crazy to me to try to sell those parcels off individually. I would think that, a Blackstone type group would want to just buy the whole thing and pay, a premium price, recognizing that the whole is more valuable than the sum of its parts.
Absolutely. I love the way you put that. And you really take a tech-driven and or entrepreneurial, creative-driven approach to this real estate game business, and built an organization. I think that's key. Now, I want to shift a little bit to capital gains tax, right? Because a lot of people, they go, look, that sounds great, Nick, and I have that big business and I want to sell that business, but I'm going to have this huge capital gains tax, right? And or I've had that real estate for 27 and a half years of multifamily and fully depreciated, or 39% or 39 years for commercial, and it's fully depreciated. Now I'm about to get recaptured. I'm about to get hit with huge capital gains taxes. So I'll start with this. What do you feel like is the biggest frustration when it comes to the 1031 exchange and the lack thereof options for clients or investors to either to be passive or to, not doesn't work for business sales or crypto or stock, or, walk us through what your biggest frustration for 1031 is.
Yeah, so as a licensed real estate agent and private equity fund manager, I've had a front row seat to a lot of 1031 exchanges. The first thing I would call out for anyone out there, contemplating a 1031 exchange, is that when the market is hot, there's almost an insider speak. And Brett, I'm sure you've kind of heard this before. So let's say you have a buyer and you're talking to other brokers looking for a deal, and you might say something like, "I've got a buyer with hot 1031 cash. I have a buyer who is under contract to sell, or is in that 1031 exchange window." And that almost immediately conveys to a counterparty that my buyer is hyper motivated and willing to pay for a premium. In fact, to a certain extent, they might even be willing to kind of take a bad deal, or a thin deal at best. So what are the things that you normally wouldn't want to show because they're not great deals? Like, my buyer is willing to take a look at it. So that's not something that most brokers are necessarily going to share with their clients, but in the broker world, that is an extremely common. I might be talking to a broker, a listing broker, and they would say, "Oh, I've got a good deal, but it's probably only a good deal for a 1031 buyer." Well, isn't that just a funny thing to say? Like, it's just such a known thing that 1031 buyers are willing to pay a premium, that you've got kind of a list of not so great deals that you don't even want to publicly market. But if someone's willing to overpay because they have 1031 money, well, here you go. So that's the first thing I would throw out there, is that I just see people make poor decisions, or not poor decisions, just that they make the best decision they can make. But with such a finite time window, like, it's difficult to make good decisions. So I would caution people about that from a 1031 perspective. You really want to do it the other way around if you can, where you're kind of hurried to sell the asset maybe instead of buy the asset, depending on market conditions and everything, and maybe make your buy contingent on you being able to successfully sell your property that you'd like to sell at a fair price that works for you. I've found people line that up very successfully in that direction, whereas they kind of get stuck when they're going in the opposite direction, because your buyer is typically the person that holds those contingencies, not the seller in that real estate sales transaction. The other thing that I'd caution people about is, I would say they're often somewhat ignorant of some of the rules associated with it. So they'll often come to me and say, "Hey, Nick, I want to do a 1031 exchange. I just sold my property." I'm like, "Okay, well, who's the intermediary you're working with?" And they'll say, "What do you mean?" And I'm like, "Okay, well, it turns out you don't have a 1031 exchange, and you don't even know it yet. As soon as you accept those funds and close on your property, you need to do some certain things." And I don't want to go into that in this podcast, but there are some points of complexity there. Another example is people reach out to me all the time and say, "Hey, I'd like to 1031 exchange into your private equity fund." So it actually is possible to do that. You can form a tenant in common structure on a property that's purchased within the private equity fund, and then let those funds let that purchase season for a few years, and then do a swap of your ownership in the tenant in common structure for for shares of ownership in the private equity fund. And it is technically feasible, but it's complex and expensive. And now you have this kind of long run maintenance, of the accounting that may or may not be more trouble than it's worth. I think you need to be doing, a $5 million deal or better to even contemplate that. But the point is, people will call all the time and say, okay, I'm selling my warehouse or my triple net, kind of very, very passive investment. And I want to roll that into your private equity fund, Nick, on a 1031 exchange. Well, we've tried to do it on multiple occasions. We have never once successfully, had someone enter our private equity fund on a 1031 exchange basis, just because of the complexity involved. So I think a lot of people are sometimes ignorant of some of the restrictions that can go with it. And these days, a significant portion of all the real estate out there is purchased in private equity funds, real estate syndications, in, I'm going to say just more sophisticated ownership structures that do not necessarily facilitate a 1031 exchange. And people, I would say, they don't realize that. They might start out buying a single family home, and then they 1031 exchange into a duplex, and then into a 12-unit apartment building. Then they go to sell that 12-unit apartment building, and they want to go make the leap to a 100-unit apartment building. Well, you're probably doing that in a joint venture partnership, real estate syndication, private equity fund, and you're kind of stuck. You have to go find like a 24-unit apartment building, something to typically double up in your 1031 exchange, and it limits your possibilities in that kind of medium-sized apartment segment. There's not a ton of those properties out there.
Yep, we couldn't agree with you more. We call that the shotgun wedding, right? And we call that selling high and buying higher 180 days later. And maybe even going into bad debt, right? Debt meaning it's 8% or 7%, and your cap rate's still at 5%. Not necessarily having the forced depreciation. It's all of the reasons why people who actually got hurt in the 2008 economic crash in multifamily, because they had bad debt and they had overpaid for the 1031. That was the single, cause. If you went back and tracked that. I was at Marcus and Millichap selling multifamily properties, and we saw a gentleman lose $50 million worth of assets because he had overpaid. The music stopped on the 1031 musical chairs, and all of a sudden he's left with too much debt and everything going sideways. He loses everything, goes bankrupt, loses his own house. And we're going, there's got to be a better way. And there is, everybody. You can go to experttaxsecrets.com to learn more about the best 1031 exit plan, and it gives you an ability to exit, defer capital gains taxes without ever having to do a 1031 exchange ever again. You can go right into private equity, just like an LP investor, no tenant in common required, no weird accounting required. Doesn't take a deferred sales trust is the strategy we invest in, but it comes into the private equity as a seamless way, just like any other investor would. And we think it's the best kept secret. In fact, we wrote a book about it, and the book's called Building a Capital Gains Tax Exit Plan, hit #1 bestseller. And this is what we do every single day to help people understand what this is and not feel trapped by that. You can go to Amazon and check that out. I'm curious, Nick, have you ever heard of a deferred sales trust before? Not to be confused with the Delaware Statutory Trust. And when I say these things, does any of that resonate?
I've vaguely heard that. I've not heard of your book before, so this conversation dovetailed nicely. I've heard of it, but I've never seen someone execute it. I need to go pick up a copy of your book and check it out. Obviously, that would potentially help lots of people be able to invest in our private equity fund if we're able to work with a mechanism like that.
Absolutely. And by the way, it also works for business sales, right? So if you go to exit that business, you're looking at, most businesses start out, and by the time they build it, they have a zero basis. They have no 1031 option at all. And they're like, wow, I've got 20, 30, 40, 50% of my sales, especially if it's a C Corp, it's going to get crushed with tax. So the proceeds are going to be about, third or half. And so you look at that and you go, well, what do I do with deferred sales trust? In fact, business sales are great for this. And then you can use it to go buy real estate. And so it works for the entrepreneur, works for the person who's retiring. And you can invest into anything you want at any time. So again, go to capitalgainstaxsolutions.com. That being said, Nick, are you ready for the lightning round?
Let's do it.
All right. So Nick, knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
I spent a very long time in the tech industry and was kind of doing real estate as like a side hustle, basically. I bought a house one year and 2 houses the next year and 4 houses the next year, until one day all of a sudden we had a third of $1 billion in assets under management. And I guess I wish I had gone all in on real estate sooner. So if anyone here is listening to this, that might be in the tech industry or something like that, just know that it can be a very successful way to invest, a way to apply yourself. I found that in tech, you had to work unbelievably hard for kind of discounted compensation or deferred compensation in a lot of ways against people who are unbelievably smart. And you had to get lucky to have, I had the great privilege to have 2 very successful exits in tech, and man, oh man, did we have to work our hearts out for it. And I think we got pretty lucky in real estate. I think it's almost the inverse of that. You almost have to kind of screw it up to be unsuccessful. You just have to be patient. It's certainly something where it's not timing the market; it's time in the market, and that makes me wish that I had just gone kind of more all in on real estate much sooner in my life, both with my capital and my attention, because I think that would have generated more net wealth for me today, which seems crazy given that I had multiple successful exits in tech, but I think I would have been even more successful in real
Cool.
estate.
Excellent. Great answer. What's the number one book you've recommended or gifted the most in the past year?
I'm a huge fan of The Alchemist. This is going to sound weird, but we have like little copies of the book in the bathroom, like the public half bath at our house. It's a great book. You can read it in less than a day. It's written like a parable from thousands of years ago, but it's a relatively modern book that has some incredibly beautiful life lessons. So go pick up a copy of The Alchemist.
Excellent. Question number 3. What's the number one way you're using Chat GPT?
So we use it extensively, especially with my technology background. Here's just a fun example of that. So we do property management, and I would challenge anyone listening to this to try to go a week without using Google. Just have a fast from Google or something for a week, and just to try to anything that you do with Google, try answering with ChatGPT. We use it anytime you're going to spend more than a few minutes doing long form correspondence. It makes a ton of sense to just pick up ChatGPT and use that instead. For example, we had a tenant move into one of our apartment buildings, townhome community, and they pulled a rolling 3-yard dumpster, like a giant dumpster, up to their unit as like their personal trash can. And we saw them roll it up, and we're like, okay, so are they throwing some things away for move in? And then 2 days later, it was still there. We're like, I think they think this is like their personal dumpster or something. How does that work? And so you could scratch your head for a half hour trying to, how do I draft something that is like friendly and professional, but also kind of stern, saying like, hey, not sure what you're up to here, but we need to formally in writing tell you can't do this or you can't stay. So you kind of put all that into Chat GPT, and it takes you 3 minutes instead of 30 minutes, and it gives you a draft of essentially a lease violation, and you say, hey, I'm a property manager, and some interesting person decided to put this dumpster up to their unit. Please send a polite but aggressive note that they can't do this, and this is their formal written warning. Okay, this looks good. Can you make it a little bit shorter? Okay, can you make it a little bit meaner? Okay, nope, that was too mean. So somewhere in meanness between the first one and the second one. Okay, that one looks polite and the right amount of mean, and then you send that off, and that whole process took you 5 minutes instead of 30 minutes. And the cognitive load is like kind of fun and playful to play around with Chat GPT, whereas it's like kind of emotionally and intellectually exhausting to actually draft that long form correspondence yourself. So that's how we use Chat GPT. I mean, we're using it 100 times a day in our property management company with our knowledge workers.
Absolutely amazing. I love how you put that. I think it's the emotional energy that we're saving that is so significant, right? Time too, right? But like the emotional, like I so relate with that. I like to just grab my phone, click on the app and talk into it, right? And just say, and I also have my screen up that I can refresh it, and then it pops up on my screen. But I just start talking and just saying, hey, ChatGPT, here's what I'm looking to do. Could you help me with this email? Could you help me with this marketing message? Could you help me with whatever this thing that I'm trying to solve? And just kind of free flow what's happened, right? Or even like I like to transcribe or have I'll have these small videos, and I'll say, hey, I'll just click it and I'll let it listen to the transcription, right, of the video. And then I'll click it in it. So now it's loaded. And then I'll say, hey, take that and make that into an email sequence. I'll take that and make that into YouTube show notes, or just anything really. It's pretty amazing. You just got to spend the time to do the thing, and it starts to become like second nature. So next question is this. What would you say you're most curious about right now in general?
Probably China. And, I'm 40 years old. I was born in 1983, so I came of age, after the fall of the Berlin Wall. So the ascension of China is kind of the big geopolitical event that's kind of dominated my entire adult life, and I think we've seen an inflection point in that kind of world order, and I think that's going to determine kind of the course of kind of the second chapter of my adult life. So. what the heck's going on over there. Like a lot of really, really strange things are happening very quickly. And I think life is going to change a whole lot. I just, I was at a mastermind, and there was someone there who lived in China for 22 years, and then they just left, in 2020 for many reasons. I spent probably like 6 or 8 hours just kind of picking their brain, asking them what was it like living in China, and why did they feel the need to leave all of a sudden. I think that's something that's we'll look back on the 2020 to 2023 period with the same reflection. As I look back on the fall of the Berlin Wall today, it's going to be a completely different world order for the next couple of decades.
Wow, and fascinating. I too was born in 1983. I feel like it's a special year. It's that transition between like knowing tech, right, and not people not knowing tech, and growing up, and then the emergence of all the tech. So that's really cool. We're out of time. This has been amazing. Very last question, Nick. After all your success, helping all the people you help, what's the number one habit that you practice to stay centered in your values and stay encouraged to charge forward to reach even higher heights?
Living in gratitude. It's easy for us to get caught up in. I had to deal with like 17 low energy things in my first, kind of 4 hours of the day today. And then I'm going to jump on a podcast. And it's just a typical Monday morning when you've got 80 employees and $3 billion in assets under management. Like on a Monday morning, a lot of things went wrong over the weekend, and sometimes they all bubble up to you at once, and you can feel overwhelmed or frustrated. And anytime I start, feeling those feelings kind of creeping into my body, into my physiology, I just stop. I've got this beautiful view in my windows here. I just stop. I'll pray. I'm a spiritual person, and just say, man, I've got so much to be grateful for. Like these are big problems, but you only have big problems if you're doing big, cool, fun stuff. It's a privilege to have these problems, that people trust me to fix these problems and think that I have the answers, and ultimately maybe God has the answers, not me. Maybe it is something I just need to pray about. So just living in gratitude at any given time. To anyone out there who's living a big life, or is going through some challenges, I've got an amazing wife, and I've got amazing kids. Whatever it is it's blessing you, just focus on those things, and whatever those feelings of frustration or panic or fear or anger, they just melt away when you just say, thank you, universe, for these amazing, for the breath within my lungs, for this beating heart that I have, and do some deep breaths, or listen to some chill music or whatever, and just live in a state of gratitude, and you will show up as your most beautiful self instantly. That's just how the human ocean works.
Love it, Nick. Love it. That's a great way to end the show. I want to thank you for being on the show. I want to thank you for using your gifts of, I think, a number of gifts, but I mean, especially, just a gift of giving, right? Giving back to your team members, to the investors, to your family, like all the things that you're doing. Like, it's amazing. And number two, being really creative in the way that you approach the business as a whole. I think it's rare out there to not see any of the fees, to hold forever, to do the simple 50-50. I think that's great. And I commend you on that. And then the last piece I would say is, I think a quote for the last piece you said was, that I've heard, it's a privilege, not a sacrifice, to pay the price for my dreams, right? It really is. And if you take that approach and that mindset, man, it does change everything. So I appreciate that. Nick, for our listeners who want to get in touch with you, would you mind one last time, what's the best place for them to find you?
Absolutely. You can go to blackswanteam.com. There's a link right there to my calendar. If you'd like to block 15 minutes to just chat, whatever I can do to serve you, it would be my privilege to do so. There's information about different ways you can connect with us. We're actually doing a state of the market talk tonight, so you can sign up for that. We just do tons of free educational content and stuff like that. We're always just providing value any way we can to all the people that we have the privilege to find in our life. So you just go to blackswanteam.com and see the ways to connect with us.
Fantastic. Thank you, Nick. And also, I want to thank all of our listeners to listen to the episode of the Capital Gains Tax Research Podcast, also stream on Expert CRE Secrets Podcast, where we believe most high net worth individuals and those who help they struggle with clarifying their capital gains tax deferral options, not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit multiple assets. And catch it here. Nick talked about he exited multiple tech business assets, right? He might have some stock, might have some gains there. He's exiting maybe a business in the future, real estate, right? People exiting real estate wanting to go into his fund. And guess what's that centerpiece that we believe is the deferred sales trust, to help with all of that, creating and preserving more wealth, deferring that tax, and being able to invest at optimal timing. You don't want to miss the book, Building a Capital Gains Tax Exit Plan, to learn all about that as well. You can go to capitalgainstaxresearch.com. You can also go to the Best 1031 Exit Plan. You want to learn more about that, you can go to experttaxsecrets.com. That's our coaching program, as well as a way for you to get started, to never have to feel trapped by 1031 ever again. Appreciate everyone out there. Please rate, review, subscribe. Please share this with someone that can be of